On this episode of Ask the Experts, I'm sitting here with Carma Peters. She is the CEO of the Michigan Legacy Credit Union. Hi, Carma.
Hi, Rick. How are you?
I'm wonderful. How are you doing today?
Doing well. Doing well.
It's great to have you here on the show. So tell me a little bit about the Michigan Legacy Credit Union.
So Michigan Legacy Credit Union is about 261 million in assets. We have 6 branches that surround Detroit, but we're not actually in Detroit proper. So our branches span 84 miles north to south and 84 miles east to west. We were one of the first credit unions to do a corporate type model back in 2007, where 3 small credit unions came together operating under our original name as part of Affinity Group. So our name used to be Affinity Group Credit Union. And then we subsequently added 2 more credit unions after that. So at one time we had 6 brands under one corporate name. And after reevaluating with our board of directors during a strategic planning, it's very expensive to do that type of model just because of the marketing dollars involved for each brand. So we came up with the name Michigan Legacy, which fits the legacy of what we've created here in Michigan, and it just works for us. So we changed our name in 2014, and we have been doing some really cool stuff since then that we're super excited about.
Oh, that's quite interesting, and you're absolutely right. Power of scale will allow you to save significantly on ad dollars. You get more bang for your buck if you're just going after one brand. So that that definitely makes a lot of sense.
Even culturally, it created some issues. So we recognize those and have unified under Michigan Legacy, and it's worked really well for us.
Sure. How many members would you say you have?
We have over 20,000 members.
Mm-hmm. Interesting. And who is the current your current target clientele? What do they look like?
It's anybody that lives in the state of Michigan. One of the unique things about credit unions is because we locally make decisions, we have the power and we look at every loan individually. So we get the opportunity to go back to the basics and look at the relationship. And that's really what we're looking for, is building those relationships with people. We like to call it designer type lending, because we really can design anything to fit our owners' budgets and make it work for them, rather than trying to fit them into a corporate box that works or maybe doesn't work for them.
Sure, like a formula-based lending solution.
Exactly.
Right. So tell me, what do credit unions, or what can Michigan Legacy do that's different than what a bank would do, or won't do, or can't do? What do you guys do differently?
Fundamentally, it's that relationship. Of course, the core principle goes back to the different foundations of bank versus credit union. So in a bank, obviously, they're looking to earn money to pay stockholders, where our stockholders, because we're a financial cooperative owned by the members, go back to the members in better rates, better services, free services. And so typically one of the things we do is give back over 1.2 million each year in fee waivers. This year in 2020, we gave back over 2 million in fee waivers with COVID. So we recognize that the money belongs to the owners, and we should use it for the benefit of the owners and not for the benefit to make stockholders.
Sure. Well, I think that's how credit unions got their start. At least my own knowledge is that it was always like a small group of people with like-minded interests who got together and pooled their money and would lend and so forth. Now it's at a much larger scale. Now, can you guys accept new members from anywhere in the United States, or do they have to live in Michigan?
Yeah, we are state chartered. So our state charter limits us to residents within the state of Michigan. So they have to be a resident of Michigan in order to join. But it's a pretty broad base for members to join.
Sure. Definitely. Now, you had mentioned COVID. Obviously, millions of Americans right now are struggling with unemployment, whether it's stubborn, continuous unemployment, or it's just staggered employment, where they're employed for a little bit and they get laid off and they find another job. What can these folks do to get help from? Like, what can the credit union do to help these folks?
Basically, just reach out and ask. That's the key thing that we're finding, the difference between what's happened in 2020 with the pandemic versus what happened in 2008 with the mortgage crisis. At that point, we didn't have people reaching out asking for help. The pandemic has truly helped build that relationship. So the collection department isn't necessarily a nasty word, and people are hesitant to reach out. They really have recognized that it can be a source of resources, tools to help them through this. And it's helped build that relationship to understand it's not an adversarial relationship, but it's a relationship of what can we do together to get you through this, rather than here's the keys to your house, which happened in 2008. We don't want it anymore. And people walked away. So I think that's made the biggest difference. I think the other thing that's really unique is we don't always have the answer. And I can admit that as a credit union CEO, but we have a lot of resources and we can steer members or owners towards those resources that may be able to help them when it's something that's just outside of our scope. And that's the difference between the relationship versus just a customer.
There's definitely something to be said by a member being able to literally pick up the phone and call somebody, or their person maybe, at the credit union to be able to discuss an issue that they might be having at that particular time. Try doing that with a big bank. It's impossible.
It's impossible.
Yeah.
Right.
You might not even be getting somebody in the country.
Exactly.
So definitely. And do you think that the situation is getting better right now?
I think that it's going to be really interesting. We're not so sure about 2021. At this point, what has been interesting is our delinquency is still at the lowest it's been historically. So we don't know if it's a can that's being kicked down the road. But everything that we're measuring it by would tell us that no, the members seem to be doing okay. I think the help that people have received has been instrumental in getting them through this. But we're kind of a little shocked. So we did a little different than the mortgage deferrals that were offered out there. When a mortgage is on the secondary market, as you know, you have to play by Fannie and Freddie rules. We found, and when we talked about that as a leadership group, that really wasn't going to help members that have lost their job to just not pay 3 payments and then have to pay 4 all at one time. So we took a little bit different approach, and it's something we can do with our portfolio loans to say, first of all, we talked to every single member that called in and said, do you need this? And what we found is a lot of people didn't. They were just really scared when the pandemic started. And so we would say, we don't recommend you doing it, because if you do, not only are you still going to have to pay these 2 payments, but the interest does still accrue. So now your 2 payments could be 4 at the end of your loan. And if you don't need it, one, we don't want to make your financial situation worse and have you pay more. But more importantly, this is a tool that if you do need it down the road, now we've exhausted that possibility. So let's save it for when you really do need it. And we were surprised at how many members said, okay, then I don't want to do anything right now. I can make my payments. And if something changes, I'll call back.
I was reading a report that when the mortgage deferrals had started, that many Americans actually didn't need to defer their mortgages, but rather they wanted to keep that money in their checking account or perhaps in their emergency fund to give them a sense of security in the event of a job loss or something that that prevented them from earning. But as you said, the problem with that, or the caveat, is that at the end of the loan, your 1 or 2 month, your every month that you defer could turn into 2 or 3 times the amount in interest that the borrower has to pay. So, which is it? So I think it really makes sense that if you didn't need to defer, why would you?
Why would you? And that was one of the things that we found out. We did have some loans that were sold on the secondary market, but we retain the servicing. So for those members that were impacted, we quickly did a refinance, moved them to our portfolio, and said, let's just give you a 60-day deferral. We'll put it on the end of the loan. And then we also told them, if you get back to work and your income starts to come back again, give us a call and we can tell you what you would need to pay to keep that same maturity and reduce that interest rather than that compounding effect that happens.
Right.
And I think most members appreciated the education and not just, and of course, the advice of servicing debt is always going to be more expensive than keeping that money and putting it in savings, because the interest you pay on the debt is always going to be more.
It's great advice. Now, you had touched on education. Tell me, what do you think is missing at home? I think, in terms of financial education, or in terms of people talking about money at home, this is a taboo topic. Nobody talks about money at home.
Nobody talks about money.
Nobody. Why is it, and how can we solve that problem?
I can only speak from my personal experience. My husband and I met in Wyoming and survived the financial crisis that the oil field created back in the late 80s. And we lost everything. And it's shameful. You're embarrassed. And I think that's what makes the difference, though, is when you've experienced it, you can truly help people when you have that experience of going through it. For example, when people are in debt, debtors often want to cut their interest if you give them access to debit the payment from your checking account. And we've seen time and time again where those creditors then have taken more than what they agreed to, or the member's situation changes and now it's really impacted them. So we don't advise that, and we say, let's make a plan and work the plan. And I think that's a big difference. It's embarrassing to be in that. It's not something that goes away quickly. So you didn't get in debt overnight. You're not going to get out of it overnight. It's hard work. But if you do the work, you make the plan and you work the plan, I think people will stay out of it just because you've been through it and you don't want to go into that pain again. But it's as easy as starting with a savings account. And for people that don't have it, I mean, we know statistically about 68% of Americans are one $600 emergency away from financial disaster. So I know for my husband and I, we started a savings, and we started it with $10 per pay. Put it away into an account that you don't have access to. You physically have to drive to get it out, because then you do stop and think about it every time. And if it is with your credit union, that's one of the things that we look at when we are underwriting is, does the person save? Do they save consistently? Or is it going in and going back out? Because the people that consistently save do have that backup plan, and they're going to be able to make it through a small emergency. And that pattern will continue, because once you start it, it's going to snowball, and you're going to save more, and you're going to save more, and the unexpected emergency now isn't unexpected because you prepared for it.
I think you're absolutely right. In fact, when, I've mentioned this several times on the show before, that I never learned about finances growing up. I had no idea. My parents were always struggling. They were the 68% that you had mentioned, always, just on the cusp. And I don't blame them for it. However, going to school. Nobody taught me anything about finance. However, banks were very quick to give me a credit card. So it wasn't until, I discovered that I was very good at business. I was very good at earning income, but spending it and investing it, I was horrible because I just never had that education. And it wasn't until around 2012 or so when I actually discovered what you had mentioned, have a separate account. And what I did was I used that separate account for my day-to-day purchases. The rest, I had one account for my rent and my bills and that sort of thing. Then I had another one for my day-to-day purchases. And I remember that very first month I ran out of money before before the mid-month. I was like, well, now what? Well, I didn't go to restaurants for the rest of the month, didn't buy any more clothes. And then from there, I also learned about, having a little bit of extra money in a savings account, and investing that monthly surplus of income that I had. It's shocking because it didn't take me any time at all, because I was leaving my spending was always beyond. But as soon as I pulled back on spending, everything just changed. And when I no longer cared about keeping up with the Joneses, debt came down, spending came down, my savings increased, my investments increased, and I just continued from there. And I think it's incredibly important advice for anyone to learn. So with that, you've talked about the plan. What sort of financial education can you give your members if they come in? I mean, can you teach them how to set up a budget?
Absolutely. We could teach them how to set up a budget. We'll review their credit report with them, go over it, see areas that need to be worked on. One of my biggest concerns are the quick fixes that you hear about that really aren't quick fixes. They're stalls, and your credit score can go back. One of the things that we've been working on with our data processor, which is local here in Michigan, is creating a customized score based on the relationship that the member has with us. Mm-hmm. So based on their history and what they do. And we intend to we're analyzing that now to look and see how we can utilize that, because we know from my history in credit unions that there are members that if they didn't fit in the FICO score box, they will still pay us. They will always pay their credit union. Sure. And so we wanted to see about building that type of a score that's indicative of the relationship rather than just what's reported by relationships that aren't truly sticky.
Sure. So, and it all comes back to character. The members' desire to be able to pay, because desire and willingness to pay is two completely different things. Exactly. And that's not something that'll get reported in a 3-digit number on a credit report.
Exactly. Yeah. And many of our credit union, 5 of our 6 branches are considered low income designated credit unions, which means our members typically have lower credit scores. So we really work with them to build that back up, tell them what they need to do to help themselves, and give them the tools. Once you give them the tools, they can do the work, and that's the rest that's on the owner, is doing the hard work.
So if people in Michigan want to know more about Michigan Legacy, where can they find you?
At michiganlegacycu.org. They can call us. We just started a new video branch. So if you go to our website, which was actually very cool in light of the pandemic, you can do everything on video that's not cash related through our new video branch, it's been really awesome and keeps members safe, which is the most important thing. Or call us, text us, call us, email us. And all of those numbers and emails, text numbers are on our website.
Beautiful. And I went ahead and I put the links in the description below. Carma, this has been a fun time. I really appreciate you introducing the credit union and what you guys do. I truly believe that you guys are making a difference in members' lives. It's just up to the member to pick up the phone and give you guys a call and start that relationship.
Thank you so much, Rick. I really enjoyed it.
You're very welcome. Take care.
Bye-bye.